No, we're good.
We're good.
Starting.
All right. Thanks, everyone, for joining us today. We've got Andrew Ziffer here and myself. We're going to go through the retail portfolio of not only what Greenleaf has, but also what we're seeing in the market right now. And big reason we did this this week versus the previous week is because we had our rate increase last week. So
Right, and we were waiting for the news to see how it impacts and what I guess all the talking heads said. And
yeah,
now we know. Now
what
we
the
know.
Fed said and what the news said.
And what our bankers are telling us now for debt.
Yeah, so we saw a 75-point increase last week, and that's the second one of these now. So two big Fed rate hikes. That obviously impacts us directly. It impacts the valuation of real estate. It impacts all the debt that we're able to get. And we think about the debt position that we're currently in. Our debt is fixed, so it doesn't impact past deals, but future deals going forwards, this 75 points probably really hasn't even been priced in.
Right. And so right now, we're operating as is. We're good for 2 years, as we'll talk about in a little bit. I mean, all our debt is we have nothing coming up in the near future. The first debt that's coming up is in 2024, and our debt is fixed. We're paying off principal. We have cash flow, and so for if we just keep everything as is for the next 18 months, we're okay. We're okay. We're good. We're good.
Well, you look at the rate increase. So obviously, doing these rate increases because of inflation that's been out there. June, the 12-month average was 9.1%. Fed's target is still 2%. So they're going to keep pushing until they see that inflation come down, which could be a little bit here.
Yeah, just hopefully they don't push too hard.
Yep, but we'll see.
Yes.
So when we think about the debt increases, the Fed rate increases, along with what inflation is doing, let's talk a little bit about the deals that we currently have, because we have three main brands. We have mostly dollar stores, which is a Dollar General or a Family Dollar. And then we have quick service restaurants like the Zaxby's.
Kind of have the two divisions. We have quick service restaurants, or QSR, which are the drive-throughs, and then also some quick serve restaurants, which are like the Applebee's.
Yeah, and then dollar stores.
And dollar stores,
those kind of, and they're all at probably the lower price points if you look at food service out there as a whole, or shopping experience as a whole.
Right. So very important too, those brands apply to a broad economic demographic, not just a very narrow. So if you think about like a fancy restaurant, that's a very narrow income demographic, but a Zaxby's and an Applebee's, I mean, their audience is a lot bigger than some of the other businesses that are unfortunately going to suffer during a economic pullback. Yeah.
But I mean, if we think about the three main brands that we have, or the types of stores we have, the quick service restaurants, we have like a Zaxby's, they've performed well, and they're also adapting well to the more takeout or more delivery model.
Right. And just as the business itself, I mean, after the Goldman Sachs investment, I mean, Goldman Sachs doesn't buy something to let it sit there and do very little. Goldman Sachs,
they want it to go.
Yeah. What you use, there's a certain word you use. They're not buying it to just sit still.
Correct.
They're buying it to move, and they're
going to try and create value through expansion and growing sales.
Because they're gonna start to sell it in 5 or 10 years for a 2x or 3x multiple.
Right. Yeah. And then dollar stores, the most of what we have are the Dollar Generals. We have the one Family Dollar, but in the market with the dollar stores, those normally do very well when you have, if you're going into a recession that people are talking about, or if people are trying to spend less, those stores normally do very well. And just, I mean, in the past 8 years, they've almost doubled their sales. They opened 7,000 stores. So they're definitely growing. They have a new CEO that's coming in November for Dollar General, who's been there, I think he's been there like 25 years. He started as a store manager.
Yeah, I thought that was interesting when you told me that.
He started as a store manager in Nashville, and now he's taken over as CEO.
It's crazy.
That is impressive. So, I mean, obviously a long-term, the hiring from within, growth-oriented company. And then Applebee's too. I mean, they got purchased by private equity. They went through their restructuring, and they've come out very strong on the other side.
And Applebee's itself is also changing their business model, where a lot of their food now is going out the side door. So our Lithia Springs Applebee's, when I did when I talked to the store manager, he said it was either 25. It was about 25% of his business was going out the side door. So that was 25.
That's higher than the chain.
Yeah, and higher than chain, and it didn't exist before. So they invented a whole new business of delivery with all the partners, the Uber Eats, the DoorDash.
DoorDash and Uber Eats have, they've kind of provided a whole other revenue source, and all of the, the margins on that are even better because their DoorDash and Uber Eats pricing is higher than in the store.
Yeah,
so they're getting better margins on that business. And with Lithia Springs, they're doing well on the amount that they have going up kind of the side door, what we call that. But I think as a chain, they're aiming to have about 18% of their Applebee's 18% of their store sales in 2023 targeted for kind of out the side door
Right. And so it's back to,
delivery model.
our strategy is working. We're buying businesses that are kind of the top businesses in the whole ecosystem of the business chain. So like Applebee's, like Lithia Springs, Seneca, Duluth, we just bought Colleen. All of these Applebee's are top performers inside the Applebee's system. And so, if there's ever a problem, it's not, these Applebee's may be affected, but these are the Applebee's that are the survivors and that are going to be around for a long time.
Yeah. Then we think about, with rate increases currently in the market, we want to take a look at just what we're seeing out there right now. So when we look at our cap rates that we're able to buy deals at versus the debt that we're currently seeing in the market. So we're always trying to buy on that spread. So we have one chart that outlines this pretty well from 2018 when we first started buying these deals until now. So
Want to bring up the chart?
we'll bring this up, and it really just shows us kind of the compression that we're seeing, and it's really been dramatic in the past month and a half.
Yeah, like the last quarter, we had hints of it, but if you look at the graph, I mean, it's really clear, like over 4 years, just think about it, over 4 years, we've been buying deals. Maybe we should back up a little bit. If you buy a deal for $1 million and you buy it at a 7 cap, but your debt is 6%, you're basically bought the deal you're making 7%, but it costs you 6% to have the deal. So you're essentially making 1% on the deal. Not necessarily a good deal, but it's kind of
that's the math.
That's the math. And so for 4 years, we've been buying deals with a spread of 3.6 or 3.7% between debt and cap rate. And that's just been our standard buying practice. And we've done it over and over again. And the chart shows like our averages over the 4 years. Now, all of a sudden, over the last quarter, that 3.6, 3.7%, look what it went to. It went to
it's a 1.8.
1.8%. So how do you buy?
But we didn't buy that deal.
No.
At 1.8%, we didn't buy it. That was basically in the past month and a half. These are the deals that we're seeing when we're looking at what does pricing look like and what are our debt options.
All right.
Because we've got a lot of deals where we're going through what's in the market. We're getting debt quotes to see what we could do on a deal. And right now, the spreads we're seeing is about 1.8%.
And if you look at the graph, if you notice the debt is going up, but the prices are staying high. So prices have not moved right now. And I'm not sure they're going to move enough to justify the actual cap rate. Because it's like, for example, the deals would have to move another 3 or another 2 points. So are these deals going to move to a 9 cap? I mean,
but also a seller at that point has to be willing to sell it then.
Right. And if I was a seller, I would just say, okay, you know what? I'm going to take a break and just hold it for the next few years and let the market sell.
And keep your spread.
Keep my spread. Yeah. And then I'll work. In the meantime, I'm paying down debt. I'm getting a cash flow from it. And what am I going to buy if I sell this? So,
in the market right now, that's making it hard for us to find opportunities, really. But it's also sellers are probably more patient than they need to be right now. I mean, or I guess maybe a different way of saying it, but sellers are being very patient. They don't need to sell.
We're being patient as sellers right now ourselves.
Yeah.
So yes.
So, all right. So that's where we kind of see things in the market. When we look at our specific deals, we can go into essentially our investment returns for the second quarter. We had essentially all of our triple net, all of our lease deals paid out in the second quarter. And as a whole, we were able to pay out about 50% more than our preferred return this quarter. So on that front, all of our deals are performing well cash flow wise. All of our deals are also principal paying. So we're paying down principal on all of our.
Was it $85,000?
Yeah, this quarter.
Just the quarter. Yeah.
So that's, a lot of these loans are not huge loans, but we're making principal payments on everything. So not only do we have a cash flow asset, it's making distributions and we're paying down principal. So we feel like we're in a good position with those. We're not interest only. We're not floating. Everything is fixed. So our investment returns that we've really done over the past 4 years are locked in.
Right. And I told everybody on the last Applebee's we did clean got 4% debt. And we clearly advertised to everybody, this is the last of the 4% debt. So if you want your last 4% interest rate deal, get in this deal because it doesn't exist anymore. So now interest rates are in the 5s, high 5s, maybe even in the 6s now. So for some questionable deals.
Yeah. And I don't think even the recent 75-point increase, only being a week ago, we haven't really gotten any new debt that has been priced with that into effect. We've looking at our debt, say mid-July or early July, to kind of put our analysis together here.
Yes.
We'll see what new debt options look like probably within the first 2 weeks of August to see how much that they're going to change on that. They're obviously going to go up
Right.
from there.
And even the housing market. So the housing market is always, it's always there right with us. And forget the
Yeah, they just hit over 6%. They pulled back a little bit on like
Right.
the average 30-year mortgages, like in the high fives right now.
and there was a statistic about how volume, I think it's commercial real estate, it's either commercial real estate volume or a segment of the commercial real estate market compared to the quarter last year, 40% down as far as transaction volume compared to last year.
Yeah.
Crazy.
I think people are able to be patient and they don't need to.
Yeah. Well, honestly, what's happening is exactly what should be happening. They're trying to slow down the economy, slow down inflation. And so,
See that.
we're seeing that. We're living it. We're exactly what they want to happen is happening, and it's happening to us, unfortunately.
Yeah. And that just limits the amount of future deals that we can buy
Right.
that are going to meet our threshold. We're not just going to go buy something to buy something. So
Right.
something that actually meets the returns that we need, that's more limited
Yep.
on what's out there. So we think about our deals as a whole, inflation, and then we also have rates rise. So rates rising, we're kind of fixed, but the inflation impact does impact our business in that some positive, some negative. On the positive side, inflation is going to drive up revenues at all of our stores.
Right. And all of our businesses, rent is just an expense. And so their rent is going to be fixed. They have a fixed rent,
Yeah.
and they know what it's going to be over the next like 10, 20 years because they have all the options. But what's going to happen is food costs, labor costs, those are all going up. And so eventually they start to, rent is not their problem anymore.
Well, we're looking at rent to sales ratios that are around 8%. So that's kind of a threshold in the industry of like, if you have a quick service restaurant, 8% rent to sales. As sales go up, that rent as a percentage of sales is going to come down. So
Right.
we're going to have stronger performing deals. So if we have a Zaxby's or an Applebee's where same store sales go up dramatically because of inflation.
Yep.
And our rent to sales ratio is now 5%, 6%. We have good backstory to try and bring that up and raise our rents to be a more in line with that 8% rent to sales ratio. But on the other hand, these same stores are now fighting wage cost and food
Right.
cost.
We're going to be the last phone call they make about cutting costs. They're going to cut costs other places. And, there's nothing we're going to do to cut costs because their rent is already affordable compared to their sales. It's super cheap.
Right.
And we always want their rent to be, it's counterintuitive.
We don't want it to be too expensive.
We want their rent to be cheap. We want to charge them below market rent. We want to be able to make money on below market rent. And we want to know that their rent is something they can afford and it's easy on them.
Correct. Yeah. So that's really where we see things going on the inflation part. The debt costs, with all of our stuff being fixed, we don't have any loans that mature until one in the middle of 2024 and one the end of 2024. So we still have a good amount of time or anything is coming due on that front.
Right. And I've heard the talking heads are saying now the 2023 or the end of 2023.
The guessing.
Yes.
The guessing of how fast the rate's going to go up and then down. And
so interest rates, hopefully will have this downward trend in 2023. And so 2024, hopefully rates will be somewhat where they are right now or were, last year.
Yeah.
Last year we could get 3.5% debt, 4% debt over and over again. And it was just easy. Now, of course, that doesn't exist anymore.
So we have 17 assets as a whole and with only 2 that come up in 2024.
Yeah.
So we feel good about that position. One of them April and then one of them is in July of 24. So we have a good amount of time on those. But I think if you just, in general, rates are probably going to be higher then than they are now.
Yep.
Possibly, but in preparing for that, we're looking at everything is principal paying. So we're paying the stuff down too, right? To get there and help. So otherwise, we could dive into some questions that we have. I know we got some at the end of quarter 2. We have some that came through here. So we'll answer questions that we have. Melody is with us today. She's going to help go through the Q&A for things that have been put in. And we'll get those kicked off.
Yeah. So our first question is from Charles Ellison. What is the capitalization rate / interest gap need to go back to for it to become attractive to purchase?
We really need over 3% on that spread. And that's how we're able to, well, one, in our model, we need over 3% because we want to have an amortizing full loan. Now that spread could be lower if you're not doing an amortized loan with principal payments, but we want to have principal payments. So we need 3% spread to be able to have an effective
Right.
deal.
And just to reiterate, the average over 4 years has been about that 3.6, 3.7,
Yeah.
3.6, 3.7. Charles, I think you're getting a pretty reliable check every quarter. And so, that's
But that
working
gives
right
us
now.
a little bit of extra profit in the deal.
Yes, yes. So the more,
Right.
and so some of our deals have a 4% spread. Some deals have maybe a 3% spread, but it kind of averages
Yeah,
out.
but 3% is really our break even on hitting the preferred returns.
Yes.
So we need to hit 3%. And then above that, we're able to make profits on it as well.
And remember, these are all cash flow deals. So we're not, I mean, we are creating some value by adding lease term and cap rate
Yeah.
compression. But, ultimately what's driving the value is the actual cash flow of the deal. And so that's what we're counting on. And those are a lot of people's
Yeah.
paychecks.
And that's a little bit of a good segue too, if we talk about just the value creation opportunities that we're currently seeing. So right now, the only way we're seeing to create value that could get us to a 3% spread if we buy something below that would be, and we're trying this with a deal right now, is buying something that has a very short-term lease, getting it under contract, and then trying to extend that lease while we're under contract to see if we can then have a long-term lease with better rates once we close. So that's a little bit of engineering in the sales process where we have to have a seller with a short-term lease be willing to engage. And then also at that same time, talking with the brand to say, are you guys willing to renegotiate your lease on a deal that we don't even own yet that we're trying to close, and then package that together to get our spread. That's a very creative way that we're able to try and negotiate to get to that 3%. But that's really the only value creation opportunity we're seeing in the market right now.
So on that note, what does rising rates do to our current loans that we have in place, specifically Applebee's, Seneca, and Dollar General, Charleston?
Yeah, so the ones that are in place, I mean, they're fixed, so they're not going to go anywhere. So I think those are pretty much, those are pretty much locked in there. They're okay. We don't have anything that's adjustable. We don't have anything that's floating.
And so those should stay as is, and
Yep.
they're not going to be up until it's either 2025 or 2026,
Yeah, on
depending on
those
when we
deals.
bought
Yeah.
them. But
So that cash flow is locked in through 2025, 2026.
so those are going to be easy ones. Those are going to be easy checks that we write every quarter. Nothing's going to change. It's just a stable cash flowing deal. Now, with Seneca, just a little side note, I mean, Applebee's did come to us and say, hey, we want to talk to you about a lease extension. But, if any of these, if any of our brands start talking to us about lease extensions, do you know what happens? Well, we talk to them about the lease extension, we get the lease extension, and what happens the day after the lease extension?
Worth more.
Right. And we generally put it up for sale.
Yes, we're doing that right now with the Dollar General, that they came to us and we were able to get a 10-year lease extension on I believe we had 2 years left. So now it's worth a lot more with that longer term lease in place, and we're looking at exit.
So during our lifetime of ownership of the property, whenever we know that, okay, this is the longest term we're ever going to have on this property, that is going to be the maximum value we have. And so that is the exit point that we look for.
Yeah.
So what is your outlook on retail spending at Dollar General or Zaxby's with consumers looking to spend less?
That's a good question too. I mean, we think with the stores that we're in, the quick service and the dollar stores, we think those are very good positions in the consumer spending kind of market to have. So if people are going to cut back, they'll probably cut back and go to places that are cheaper. And that's definitely quick service restaurants, or especially the dollar stores. Just dollar stores are predominantly do very well in the comparatively. Like you're going to shop less at like maybe a Target, right? You'll probably go more to a dollar store if you're looking to save money.
It's somewhat a recession-proof business because, a family still needs to eat. So if a family can't go to, I don't know, a fancy restaurant to go eat for $4 because it's going to cost $100, they're going to go to Applebee's, or they can go to Zaxby's and they can get a very quick meal. And Zaxby's, of course, is convenient. It's easy. And there's a drive-through. And if you really want to, you just make a phone call and it gets delivered to your front door. So, of all these businesses that cater to an inexpensive ticket price I think are the businesses that are going to
Yeah.
survive. The businesses that have expensive ticket prices, like we had the banker buy us dinner last night. Those are the
It's
businesses.
expensive. Yeah,
Those are the
those
businesses.
are probably going to get hit a little bit more.
Yeah, they'll get hit more. They're going to get hit more than an Applebee's or a Zaxby's.
What are the next loans that you have coming due, and do you have any plans to refinance them?
So, I mean, the next two we have are really the two that come in April and July of 2024.
2024, correct.
But that's it. We only have those two. And I mean, we would like to refinance them at that point, not now. So we don't have anything. We don't really have anything in the next 18 months that we plan on refinancing.
So
Nothing rest of this year, nothing throughout 2023 that we would be refinancing.
So we're coasting for the next 2 years, essentially, with the existing debt. We have nothing to do with our debt right now, as far as the retail portfolio is concerned.
Okay, so is inflation on our side?
Inflation
You know,
is on our side.
We think a little bit right now that it is. Obviously, we don't want inflation to go totally off the charts and really hamper the economy as a whole. But with a little bit of rising prices, we're seeing that help
Our rent gets cheaper as prices get more
it
expensive.
helps our ratios when we're looking at the deal.
So when a Zaxby's goes from $2 million in sales to $2.2 million in sales, our rent that we charge them becomes cheaper to them. So their ratios go down, and it makes it less of an impact to their bottom line. They're more concerned about chicken prices than their rent. Right.
Our last question is more of an operations type of question or process. When do I see distributions, if they are dated in June, in the portal?
So that's, process wise on how we do our accounting. When we close our month end, so for the second quarter, we close our month end in June, and then we make our distributions that go out on July 20th. So we'll close the month. We see all of the financial positions from the financial statements there, balance sheets, statements. And then from there, we calculate what the distributions are going to be. We post those distributions into our investment portal as basically an end of June entry, and then they're distributed on July 20th. So when they go out on July 20th, they probably hit a bank account around 21st or 22nd, but everything is posted kind of at that end of quarter. So even third quarter, when we close out September, at the end of September, we'll finish and lock down the balance sheets and the income statements. We'll post what the distributions amounts are going to be, and then we'll distribute on October 20th.
Those are all our questions.
Well, thanks. Thanks for
Yeah.
joining us.
Thank you very much, everyone. Have a good rest of the day.
Yeah, we have the music queued up for the ending, or not yet?
No music queued up. We don't even have one of those little clapper
Okay,
things that
maybe
ends
for
it.
the next one.
It just goes off.
Okay.